Well, the Reserve Bank's Monetary Policy Committee voted by 4-2 in favour of raising interest rates today, just by 25 basis points. And for the first time in 10 months, interest rates have gone up. Prime at breakfast time tomorrow will sit at 9.5%. Dr. Adrian Saville, the chief strategist at Citadel, joins us on the line from Johannesburg. Adrian, you've applauded this decision. Why?
Evening, Bruce. I think it recognises the primary mandate of the South African Reserve Bank isn't to foster or sponsor economic growth, but rather to look after the stability of the currency. That's their primary mandate. And if inflation is heading above the 6%, the roof of the 6% tunnel, it's incumbent on them to raise rates. I think it also equips them to raise rates ahead of the widely anticipated Fed hike.
Now, a couple of things you raised there, Adrian, are going to make a couple of people cross. One of them is Dennis Ryder, who contacted me via Twitter this afternoon and said it's time to review the Reserve Bank's mandate to include a growth component. Now, I think they've been very cognizant of growth, even though it's not part of the official mandate, for a very long time. And that's why rates have stayed as low as they have. But that core mandate is to ensure that that inflation stays between 3 and 6%, or as close thereto as possible through some quite tumultuous cycles.
Well, when you start blending economic growth policies with monetary policies, if you get this spectacularly wrong, you get into the business of being Zimbabwe. And by keeping growth separate from monetary policy, what you do is you look after the integrity, the stability of your currency, which ultimately is it's a lubricant or a facilitator of economic activity and nothing more. If I suppose we could be really sympathetic with the view that the Reserve Bank should be in the business of growth, if South Africa was an economy in which low interest rates responded or saw a response of spectacular investment spending. You don't see that in South Africa. Investment spending is blissfully ignorant of interest rates, and what responds to interest rates is consumer spending. And consumer spending is not a source of growth, it's a consequence of growth. I don't think appealing to the Reserve Bank as a source or origin of growth is the way to go. The problems are in the structure of the economy, rather.
Absolutely. And there's also the problem, of course, is if you choose to turn a blind eye to just a dash of inflation, if inflation went to 8% for a little bit, but there was a growth drive behind it, and we saw growth go to 4%, there's some people who would say, oh, that would be wonderful, wouldn't it? We'd get jobs going and it'd be great. And then when the time came, we could just tighten up on interest rates and take inflation out of the system. That's fine if you are a magician.
Yeah, it's all good and well, and there's a couple of ingredients that I think people imagine can magically cause economic growth and solve problems such as unemployment. One being if you weaken the currency, and the other is if you make money abundantly available, if you make money cheap. And as much as I wish that was the case, because it would then make solving economic ills that much easier, neither of those two translate into inclusive economic growth. We have to look much more broadly at the things that choke economic activity and also prevent the absorption of people into the workforce.
What's particularly interesting about today's Monetary Policy Committee meeting was the level of disclosure that the Reserve Bank gave. For the first time ever, a huge amount of transparency. They actually published their assumptions. So their worries about global food prices next year, their worries that oil prices will go up next year, plus their very real worry about growth getting no better than 2.3% over the next 2 years. They've actually given away quite a lot of the thinking behind this decision.
Yeah, and my response to that is, I suppose, two-legged, because it really helps to know what they're thinking, what their modeling looks like. It helps us as economists build better models. It helps us anticipate more effectively, more robustly what their response might be as policymakers. And businesses hate surprises. So by revealing your assumptions, you remove, I think, part of the risk and part of the element of surprise. At the same time, there's some interesting recent research which shows what has happened in the United States under the Fed as the Fed has become increasingly transparent. Far from it turning into greater economic stability, the transparency has actually corresponded with even more uncertainty. So I'm not sure that this removes the problem of uncertainty. The reason why I'm not so sure is because the Fed, of course, is a pivotal policymaker and has global influence, whereas the SARB is going to have domestic and local influence.
There we go. Thank you, Dr. Adrian Saville, Chief Investment Strategist at Citadel.